For decades, building wealth in India meant accumulating brick, mortar, and physical gold. In an economy characterized by high inflation, these tangible assets were the primary engines for growing capital. But over the last 10 years, the landscape changed. Financial services digitized, and domestic retail investors moved into equity markets at a rate we haven't seen before. The 2024 Union Budget updated the rules for this wealth creation, redefining the tax calculation for both property and financial instruments. This budget removed the indexation benefit, the provision that allowed property owners to adjust their purchase price for inflation. This shift effectively ended the practice of using inflation to lower taxable gains on real estate. As this graphic shows, there is now a single standard. A 12.5% flat tax applies to long-term gains across both physical property and equity mutual funds. This creates a specific dilemma. For a 15 to 20-year horizon, do you lock surplus capital into the leveraged growth of physical property or channel it into liquid, compounding mutual funds? The scale of this choice is massive. Urban real estate across top cities holds over 5.5 lakh crore rupees, while the mutual fund industry has grown to more than 23 crore folios. With the historical tax advantage removed, the choice comes down to the raw data. We need to deconstruct the friction, the risk, and the compounding math to see which asset produces the higher terminal value. Theoretical returns often look better on a spreadsheet than they do in a bank account, because real-world transactional friction degrades the actual profit. This waterfall chart shows the cost of entry for real estate. When you buy a 1 crore rupee home, stamp duties and registration fees create an immediate loss of 5 to 11% of your capital. This means the investment begins in negative equity. The property must appreciate by 12 to 13% just to recover the initial costs and return to a zero-sum position. Real estate also requires recurring capital. Municipal property taxes create a continuous drain on the property's total yield year after year. Then there is the cost of maintenance. In many housing societies, if monthly charges exceed 7,500 rupees, an 18% GST applies to the whole amount. This further lowers the already modest rental yields found in Indian cities. Mutual funds operate with significantly lower friction. There are no stamp duties or property taxes. The primary recurring cost is the total expense ratio, or TER. By selecting a direct plan instead of a regular plan, you bypass distributor commissions. This fractional saving can preserve millions of rupees in capital over a multi-decade horizon. There is also the issue of access. Mutual fund units can be liquidated digitally with cash reaching your account in 2 days. Selling property often takes months of finding buyers, negotiating, and clearing titles. Conclusively, while real estate requires high, unrecoverable capital outlays that drag down the return, mutual funds allow capital to stay deployed and compound more efficiently. To evaluate these assets fairly, we have to distinguish between two types of risk: the systemic volatility of the markets and the idiosyncratic risks of physical ownership. On this matrix, we plot mutual fund risk in the high probability but low severity quadrant. This is market volatility. It is frequent, but the asset remains liquid and intact. Historical data indicates that mid and small cap funds will see 2 or 3 years of negative returns every decade. The fluctuation is a known part of the cycle. Real estate introduces execution risk. Currently, 62% of ongoing RERA registered projects are delayed past their promised completion dates. A delay creates a dual financial burden. The buyer must pay the mortgage EMI to the bank while also paying rent for their current housing out of pocket. There is also the threat of litigation. 66% of all active civil cases in the Indian judicial system involve property disputes. Earnest mutual funds require you to manage the psychological stress of market cycles. Real estate carries the risk of asset paralysis, where litigation can lock up your capital for years. Looking at unleveraged historical averages, the Nifty 50 has grown at about 14% annually over 20 years. Broad urban real estate has averaged roughly 7.8%. This line graph shows the difference between paying a mortgage EMI and investing that same capital into a systematic investment plan, or SIP. The property equity line stays flat for the first 7 years. Because interest is front-loaded in a mortgage, your initial payments go to the bank rather than building ownership in the asset. In an SIP, the capital begins compounding from the first day. Without the drag of interest payments, the mutual fund corpus typically overtakes the net equity of the property well before the 20-year mark. Real estate's primary advantage is its use of safe, subsidized mortgage leverage. This is how property remains a competitive wealth builder. With a 20% down payment, you control 100% of the asset's growth. This leverage can turn a moderate 8% property gain into a significant return on your actual cash invested. The mortgage also acts as forced savings. The legal requirement to pay an EMI prevents investors from pulling their capital out prematurely, which often happens in the more liquid equity markets. Mutual funds lead in pure, unleveraged compounding. Real estate relies on the multiplier effect of debt to bridge that performance gap. The 2024 budget removed the historical tax arbitrage for property, placing both asset classes on similar footing for the current cycle. The optimal strategy depends on your current assets. It starts with a single question: do you own a primary residence? If the answer is no, purchasing a home is a logical move. It functions as a quantifiable hedge against future rent inflation and provides access to the subsidized leverage that makes real estate competitive. However, if you already own a home, buying a second residential property for investment is often inefficient. The data suggests that surplus capital generates a higher return when routed into the equity markets. For those who still want property exposure, commercial real estate investment trusts provide a middle ground. They offer the yields of commercial property with the liquidity and regulation of the financial markets. Once a primary home is secured, the lack of execution risk and the compounding history of direct equity mutual funds give them the more efficient route for those looking to maximize their long-term net worth.